Hello, everyone. This is Sebastian McMahon from IA Financial Group. It's playoff season, so as long as the Habs are in the playoffs, I will be wearing this shirt here and bringing you the weekly economic news and what matters in the markets. So the title of the review this week is more of the same because on again, off again, the news flow is pretty hectic, but in the end, markets are just seeing more of the same. Trump pivoting, Iran holding their stance. So, let's see where that leads us. But, the markets are close to all-time highs again. Before we get into the details, maybe just a little publicity for our latest white paper on AI. So the first in a series that we'll be publishing over the next few months. This one, we called it Paranoid Android Revolution or Transition. So we dug into what the current academic research has to say on AI, and we focus on the labor market. So basically, AI is a series of subdomains that when put together, they bring what we call AI, so image recognition, speech recognition, and all of those technologies. And those technologies can either augment tasks or automate tasks. And of course, the immediate impact would be on the labor market. So with that lens, this is kind of a bottoms-up educational piece that we put together. The link is at the bottom of the screen here, and I strongly encourage you to give it a look. I'm sure you'll learn a few things along the way. So this is done. Now looking at the markets this week at the close on Thursday. So we had a solid rebound last week. This week was more of a risk-off week. Pretty much everywhere, emerging markets were higher. We were expecting talks in Pakistan at the beginning of the week. Iran didn't show up, so JD Vance, the U.S. Vice President, didn't go. So that led to a bit of a risk-off tone. Also, as the conflict is dragging on, the price of oil continues to be, let's say, a focus. Price of oil up 14% on the week, and the USD returned as a safe haven, so that pressured USD, the CAD, euro, and the price of gold lower. So that's the story for the week. So I've been spending the last 2 weeks on the road, so there was no review last week because of that. But maybe just a few highlights from the stories that I was discussing while I was on the road. First, again, a very important chart. This is the economic signal right now. Chart on the left, you've seen that quite often from us. So this is our main leading indicator. We look at the global monetary policy cycle. When central banks are cutting in synchronized fashion, the red line goes up. When they're hiking in synchronized fashion, the red line goes down. And this is a leading indicator by about 11 months of the global economic cycle, so the blue line. So what the chart is telling us is that this oil shock is hitting the world economy at a very resilient time, and there's still some tailwind for the rest of 2026. That could peak in early 2027. That could turn the tailwind could turn into a side wind and eventually become a headwind somewhere later in 2027 or maybe in 2028. And the chart on the left is kind of confirmed by the chart on the right, which is the leading economic indicators from the OECD. So about 94% of developed countries now are seeing a leading economic indicator, which is pointing to acceleration of growth. So this is the economic signal that matters. But now, whether our index is peaking now, and if we'll see some continuation of the tailwind in 2027, you need to look at what markets are pricing in now. So this next slide here, you see that rates went up and then they went down, and now what markets are pricing is that we will start to see some hikes starting from here. So there's good reasons to think that 2027 could not be as, let's say, friendly as a backdrop as 2026. And what's priced right now this morning in the markets, no cut, no hike from the Fed this year, one hike by the Bank of Canada in October, 3 hikes by the ECB, 2 hikes by the BOJ. So this is what's priced now. So the global cutting cycle is seen as being mostly over. And when we pivot to rather focus on the Bank of Canada and the Federal Reserve, so the charts here, Fed on the left, BOC on the right, At the beginning of the year, up to 3 cuts were expected in the US. We were very clear in our opinion that this was way too much. We didn't think that would be reasonable. And now markets are thinking no change, and we think this is reasonable. The US economy is strong, inflation is sticky, so we don't think there's a case for rate cuts in 2026, and markets has rallied to that view. Bank of Canada markets were pricing in some odds of a hike, because remember that the neutral range is between 225 and 325, with 275 being the middle point, and now we're at the bottom of the range at 225. So we could have a few hikes to normalize monetary policy in Canada. That's what that means. So some odds of that, but at some point when markets were pricing in 3 hikes, now it's 1.5, let's say. We still think that's a bit too much. If we price, let's say, 50% of odds of 1 hike, we think that would be more, let's say, consistent with what we're seeing and what the Bank of Canada is saying. So we still think that the Bank of Canada maybe is priced in for too much. So we agree with the chart on the left, but we think the chart on the right has some room to deprice. Now, the most important economic indicator of 2026, we've been very clear for that, for Canada, is the Bank of Canada's Business Outlook Survey. And the chart on the left here shows that for the last 3 years, so the last 12 quarters, the balance of opinion was negative for Canada. So businesses were on net pessimistic. And if we want to have this transition of our economic model, it's good to see that the federal government is trying to do everything it can to, support some growth and to pivot and talking about diversifying the markets and all of that. But in the end, it's the businesses that have to do that. So we need to see some more optimism from businesses. On chart on the right, you see that the future investments in machinery and equipment, it rebounded quite strongly. The chart on the left, I forgot to mention, but it was negative for 12 quarters. Now it's still slightly negative, but we can say it's pretty much neutral. So there's been good progress. So pointing in the right direction, but not yet net optimistic. I haven't brought it here, but also the employment intentions have jumped as well. So we're seeing good things. We're not there yet, but very good development here. Let's see what the next few quarters bring. Now, maybe pivoting to one last topic, the AI trade has been left for dead for most of the year. Remember 2025, it was all about the AI trade, and it was a rotating trade, Mag 7, and then after that, building the data centers and commodities and energy and then memory and all of these. Early 2026 was more about the AI losers coming from cloud code and all of these things. But since now the market is focusing more on Iran, in the backdrop, we're seeing very solid things. We're seeing the exports from South Korea jumping. We're seeing the same thing from Taiwan and from Vietnam, and those countries tend to export a lot of what goes into the construction of the data centers. So it's been booming, and South Korea exports, more precisely, are a very good leading indicator of earnings per share, or the growth of earnings on the S&P 500, and it's showing some good things here. And Anthropic is having quite a year. On the right, you see the annual recurring revenues for OpenAI in black, Anthropic in blue, and the growth in recurring earnings from Anthropic went from, the annualized value went from 9 billion in January of this year. So it's mostly months. It's not the frequency is not that consistent here, but mostly months, 9 billion in January to 30 billion in April. And the forecasts are for over 100 billion by the end of the year. We'll see if that happens. But what we're seeing now in this quarter, it counts among the steepest rises in the history of markets. So there's still some good things going on in the background, and we're not seeing, the market is not talking that much about it. So there might be a very solid opportunity here to add some exposure to the AI trade, at least as a firm. We're quite positive on the prospects for the AI trade in 2026. So lots of material here. What we'll be watching next week, we'll have rate decisions from the Bank of Canada and the Fed. We're not expecting anything, but the messaging, the wording is going to be very important. It's going to be the last meeting from the Fed Chair Jerome Powell. So we'll see what happens after that. February GDP, we'll have the Conference Board Consumer Confidence Index, we'll have the core PCE inflation index in the US. We are not expecting growth or a strong impact from oil on core inflation yet. that would be actually a solid development. If that was the case, that's a risk that we're seeing for next week. And ISM manufacturing should be higher because the global macro tailwind is strong, and also the inventory cycle here is leading the pack. So lots of material this week. It's always a pleasure to serve you. Busy times, so we'll be here to analyze the news flow next week as well as usual. So if you appreciate the content here, please share, and of course, come back next week.